Good afternoon. This is Chris Robinson, Robinson Ag Marketing. Today's post-close grain and livestock comments for the end of the day here, Tuesday the 10th. We dodged a bullet with another USDA report. They did cut the carry up for corn. They did raise the production for beans in South America. One interesting piece of information I was just discussing with another client. The cost of buying U.S. beans FOB versus um, South American beans, it's $40 higher per package, right? So I don't know why China would be talking about spending an extra $300 million just to buy our beans for political reasons. That to me seems odd. And the fact that they increased the size of the Brazilian crop of soybeans, they left our carryout for beans alone. They tightened up the carryout a bit for corn. We all know we've been talking about this for a while that the exports for corn have been really good, and there's been some questions, at least on my part, why we can't really break out of this range and you know reward all these good exports. So nothing earth-shattering on this report. I think the next report that's going to really matter is going to be acres, um, the planting intentions at the end of March. We will get another USDA next month, but all in all, I guess if there had to be an outcome for this, it was positive. For the end of the day, March corn finished unchanged, despite the fact that they cut our carry out. Geese crop corn finished up a penny. The high so far for the year in marketing possibilities for December corn was 466. That was after that was on the last USDA report on the 12th of January. So we're sitting here at 58 and a quarter. Call that a win if you want to. New crop soybeans back up above 1102. If you've been following my letter, I know been pointing out, 1102 was a big technical bounce. It was a 62% bounce of the break from 1130 down to 1055. If you don't have anything sold or hedged, I am not averse to doing something here at this level, 1106 area. A good place to get started. You can still get very cheap 45-day options. I think there's somewhere between 7 and 8 cents. You can get a really good hedge for the next 45 days. And why would you do that? Well, it's a substitute sale. We just had a 50-cent rally. Can we spend 6 or 7 or 8 cents on a put? Then hopefully have the cash market rally another 50 cents. If you are making sales into this market, or if you've made them already and didn't re-own them, I was going through the book this morning, and I had several guys that when we had that last report, and we had a couple dips after it. They were concerned that they had oversold stuff earlier when we were about 1105. Lo and behold, we had some of those calls that, we did some call spreads. They were, we spent 8 cents to try to make, 60, 70 cents. Those paid off well. So why am I saying that? Well, hedging is not all about just protecting the downside. You feel free if you make a sale, but you think that you want to keep the upside open. You do not have to spend a ton of money to go out there and price some cheap call spreads. And lots of times, if you call spread, if you stay in that math program where you spend 25 cents to try to make a dollar, or okay, you spend 10 cents to try to make 40, 10 cents to try to make 60, something like that. Those are good risk reward areas. And again, are they promised? Is it a promise that they're going to work? No. But there are some strategies out there where, if it's something where you want to try and re-own something, if you think that maybe, I sold too many beans and I don't want to be out of position if we pop higher, make sure you re-own them. Okay. And sometimes it's best to be mechanical about it, right? You say, okay, over the next 2 weeks, I want to re-own my beans. You spread it out mechanically. You do it, Monday, Wednesday, Friday, or if you do happen to get a big break, a big sell-off, that's usually a good day to try and price some calls. We got a lot of 2026 ahead of us. There's a lot of uncertainty. I'm not the type of person that gets too bullish or too bearish. I am interested into trying to understand why China would pay up for our beans and spend all that extra money when they can buy them cheaper in South America. And again, USDA increased the size of Brazil's crop. That crop's not getting any smaller. So to see new crop beans above 1106 again, 1105, 1106, traded as high as 1107 and a half, that's a gift, in my opinion. So I'm not worried about the why so much. I just want to make sure that we're doing the best we can to reward those. And even in the wheat held in there. It was only down a half cent. Um, Traded down to 24 and a half, as high as 31, settled at 28 and a quarter, so down a half cent there. So that's my wrap up of USDA. A couple interesting items out there. I think we're back to watching the weather in South America and also watching the harvest in South America. And we're watching to see if China continues to sort of take this odd stance where they're willing to pay more for our beans than they would if they bought them in South America. How much longer will that last? I don't know. In the protein complex, are we rolling over? Is the top end? I don't know. That was a costly mistake a lot of people made on this last rally. Remember, we rallied 35, $40. It looks like we might be pausing here a little bit. So if you're concerned that the market may roll over on you, it's not too late to get some hedges on the books. If you can't see, we had a $70 rally in feeders. If there's not a part of that you don't see that's worth protecting, well, then by all means, don't hedge. But that's a big chunk of revenue that you might want to try and protect. And if you're looking for strategy like that, um, give me a call or sign up for my letter. Reach out to me directly. I can give you some suggestions that may appeal to you that are separate from just selling the board. Because if you sell the board and then we roll over, yeah, you get a great hedge. But if you sell the board and then we rally another 25 or $30, well, you've capped your profits on the board, and then you end up making margin calls. Yeah, I understand you have the animals and it's a hedge, but in markets like this, it's much nicer, at least emotionally and financially, if you say, okay, I'm going to spend 5 or 6 cents on this option, on this put, and then the market rallies 30 cents, your put option is still worth a dollar or two, uh, and you've gained everything in the cash market and you haven't made any margin calls. That's the attraction to using long put strategies for producers. Quick wrap up: April fat cattle finished down 77 cents at 237.42. March feeders finished down 267 at 364.77, under 365. We will see the rest of the week if we can stay above 360. And then the lean hogs, April down a buck 22. That's something interesting to look at too, as well. I'm not telling you to hedge your cattle with a hog put, but hogs gapped open lower on Monday. They were lower again today, so they kind of have their work cut out for them. If you look at April got very, very close to hitting the buck. The high was 98.75 2 days in a row. We couldn't get the dollar print. Um, you know, don't be in a situation where you let 95-cent hogs, morph back into 82-cent hogs. Because that's where this whole thing started. Again, nobody sells the high. What we try and do with our hedges for our producers is to capture the meat of the move. And also, so you want to set a hedge, and you also want to avoid making margin calls because at the end of the day, you're already long. You're always long. You want to defend that position, and that's the type of hedges that I recommend. If you're interested in finding out more, sign up for my letter, Robinson Ag Marketing. Give me a call, 312-638-8868. I make the best suggestions I can. Then I also try and manage them for you. A lot of brokers will put something on for you, and then you don't hear from them again until the option's expired. During the life of an option, sometimes an option will double or triple in value. Those are the opportunities we try to take advantage of to help put some more money in your pocket, maintain your hedge, but pull profits off of hedges. An example of that, I had some cheap calls on that we bought for soybeans, not because I knew we were going to rally or anything crazy like that. It was just because we wanted to re-own sales that we had made earlier. And I had some call options that we had spent 8 or 9 cents for, and call spreads. And I think they were 1080, 1180s. And lo and behold, those things were today, trading around 40 cents. So they can work. They can be very successful. They can help your marketing budget. I'm not one of those people that say, guarantee put this trade on and we'll make so much money we can buy an NFL franchise. That's insanity. But there are opportunities out there for good hedges, and those are the types of hedges that we look for, where you have a defined risk, where you know it's going to cost you 8 to 10 cents, and with a defined possible profit. And that's a perfect example. Now, why did we take the options off right in front of the report? Because I didn't know if we were going to be bullish or bearish. For those individuals that had those on, we uh, took profits on those calls, either rolled them up or sold them and then replaced them with cheaper options. So you spend 8 or 10 cents, pulled off 40, pocket that 32 cents. You can turn around and say, okay, I'd like to re-own again in case the market continues to go higher. And that's an example of what we did today for clients going into this report. For other clients that were concerned that prices were going to collapse, um, remember that last USDA report? That was pretty nasty, right? So we looked at a bunch of cheap downside puts as well. Today's action, we didn't need them. So that is why we hedge, because we don't have a crystal ball. And if you're looking for that approach, kind of a balanced risk management approach, that's what I try and do, Robinson Ag Marketing. Okay, guys, have a great day. Give me a call. Take care.